Good day, ladies and gentlemen. Once again, another recording on a topic based on Chapter 5 called Revenue from Contracts with Customers. IFRS 15 is the standard that this chapter is under. We'll be doing two contracts in this recording. The first one will be cancelable contract in the event of non-compliance and a non-cancelable contract in the event of non-compliance. However, the previous recording, I think, has touched base on some of the important terminology and journal entries, debit or credit. However, this one, I hope that it will also add value to your knowledge. Now it says, first of all, let us read the requirements. I prefer to know what is required before I read the information so that I can prepare my mind with the requirements. It says we are required to prepare all journals relating to the information presented above in the General Journal of Digital Limited, assuming that the contract is cancelable in the event of non-performance. That means if the other party does not perform, therefore now this contract can be cancelled. It is binding to a certain extent that we must comply to the terms of this contract. Then the second one says the contract is non-cancelable in the event of non-performance. The minute the contract is non-cancelable in the event of non-performance, that means even if the company does not perform, but the customer will still owe the company on the date the customer promised to deliver. And remember, now we are recording from the company perspective, not from the customer perspective. Now it says Digital Limited entered into a contract with GAAP, which is GAAP Limited, on the 2nd of January 2018 for the supply of the decoder and the digital dish, as well as the installation of the dish on GAP's building. So now we can see that there is a supply of the decoder and that of the digital dish. This seems to be performance obligation 1, and further say as well as the installation of the dish. So now that means I think we can conclude and say this will be performance obligation 2. And these two performance obligations can all be performed in one day. At the same time, they can be performed in 2 different days or at 2 different time intervals. So now if these two are all performed in one day, then we'll record everything in one day. But if they are all recorded once, but if they are performed at different dates, therefore now we'll have to record them at the different dates, obviously after the time the customer has obtained the control of that which has been delivered. Therefore now it further says, and again on the importance of date, we need to note that the date these two parties agreed or signed this agreement or entered into a contract is never important for any recording, unless there can be a transaction that takes place on that date. That means where then now the company can perform the obligation on the same date the contract was signed, or the customer makes the payment on the same date the contract was signed. Therefore, now there can be a transaction to be recorded on the date the contract was signed. But in most of the cases, it does not happen. But if that can happen, please be aware that you'll have to record depending on which of the two that would have happened, as I've mentioned before. Now, it further says that Digital Limited promised to perform their obligation on the 25th of January 2018. Remember, we are doing the books of Digital Limited. We are required to prepare general journals of Digital Limited. Now, the company promised to make or to perform their obligation on the 25th of January 2018. Now, from the perspective of Digital Limited, we don't record anything on this date. It does not matter either the contract is cancelable or non-cancelable unless the company performs on that date. So now it's only important this date if the company performs on this date. If the company does not perform on this date, then this date is not important. So please also be mindful. It is important on condition and it's not important on certain conditions. Now, if obviously there's nothing happening on this date, there will be nothing to be recorded. It further says that GAAP Limited was to pay an amount of 1,000 for the installation and 2,500 for the supply of the product. Remember, the supply, it is the supply of the decoder and the dish and the installation. Now, take note of the fact that we start with the installation, that the installation is an amount of 1,000 rands, and the other part of the product to be delivered, it is the digital dish, and the supply of the digital dish, it is 2,500 rands. Be mindful of the fact that these two now have been swapped around, and please do record accordingly. Now it says GAAP Limited was to pay an amount of 1,000 for the installation and 2,500 for the supply of the products, which is the decoder and the digital dish. The payment, so now that is also giving us more clarity to say now there are two performance obligations. Remember, one of the steps when it comes to this topic, the point where we end up to recognize the revenue. The steps, one of them is to allocate the contract price to the performance obligations. Allocate the contract price to the different performance obligations. So now we can be clear that the contract price here, it is 3,500. This is the contract price. And out of this 3,500, 1,000 is for performance obligation, which is the installation. Then 2,500 out of the contract price, it is for the supply. So now we have allocated the price to the different performance obligation. That means each performance obligation has its own price, or has its own value, or has its own consideration. So now that is also made clear in here. Then it further says that the payment was to be made in advance on the 15th of January 2018. Therefore, now this date becomes important again. It's important on condition. I want to highlight that one also. This date becomes important if the contract is non-cancelable. More especially if the contract is non-cancelable. It does not mean it's not important when the contract is cancelable. I'll also explain all these conditions, which I partly, if not all, highlighted also in the previous recording. If now the customer does not pay us on this date, that means if the customer pay after this date, then we need to record on this date. And when we record on this date, what will be debited will be receivable asset. What will be credited, it can depend on either we have performed our obligation or we have not yet performed our obligation. But at this point, we say this date is important. If the customer pays after this date, then we need to recognize that the customer is owing us, more especially or more specifically when the contract is non-cancelable. Now, when the contract is non-cancelable, I want to go to this number 2. When the contract is non-cancelable and the customer does not pay on this date, that means the customer pays after this date. And assuming once again that we have not yet performed our obligation, that is my assumption. So now what we are going to say is to say, customer, you are owing us. Receivable asset is to say, customer, you are owing us this consideration. Then we record the amount the customer promised to pay us. And it says, the payment was to be made in advance on the 15th of January, and the customer is not paying 50% or 30%. The customer is expected to pay the full amount. Sometimes they can say the customer will pay a certain portion, but in this case they said the payment was to be made in advance on the 15th of January 2018. Therefore, now we assume that the customer is supposed to be paying the full amount of the contract, which is 3,500 rands, as opposed to portions of deposits. Therefore, now, if we have not performed our obligation, please be mindful of that. If we have not performed our obligation and the customer has not paid us by this date, then we are going to credit contract liability. We are going to credit contract liability to indicate that, customer, you are owing us. That means we as a company are saying that we have obtained an unconditional right to a consideration. What does an unconditional right to a consideration means? Please check this on page 130. They explain all the details in there about conditional and unconditional. But when the contract is non-cancelable, the customer owes us money unconditionally on the date the customer promised to pay us. What do we mean that the customer is owing us money on the date he promised us and the amount he owes us is unconditional? In other words, we are saying the contract is non-cancelable. That means the customer is owing the company on the date promised, because this contract cannot be cancelled. You are owing me even if the company did not perform their obligation, if they were supposed to perform the obligation before the 15th of January. So if the company did not perform maybe as they promised before the 15th of January, but because the contract is binding, remember, when the contract is binding, in this case it is non-cancelable. It cannot be cancelled. It does not matter even if the other party does not perform, which therefore means that when a contract is non-cancelable, this is very important. When the contract is non-cancelable, it means we always have receivable asset or account receivables. Whenever the contract is non-cancelable, the only asset or the second asset that you'll have except bank when we receive money will be receivable asset. You will never ever have contract asset under a contract that is non-cancelable. When the contract is non-cancelable, the other asset except bank will be receivable asset. Not ever will you have contract asset under a non-cancelable contract. You will have two of these when the contract is cancelable. That means when the contract is cancelable, you can have receivable asset and you can also have contract asset. That means where the company obtains a conditional right to a consideration. That means the company still has to perform another obligation in the future after they have performed the first obligation. That is on page 130 again of your gripping gap, the 2021-2022 gripping gap. Now let us then now go to the actual recording. I was still busy with the analysis. So this date once again is important if the customer pay after the promised date. Now, if it can happen that the customer pay before the promised date, therefore the promised date becomes irrelevant. Why am I saying the promised date becomes irrelevant? Let me just give you one simple example. If you get a promise of marriage that you'll get married in December, but you end up getting married in June, which is 6 months before December, therefore the initial promise date, which is December, becomes irrelevant because you got married before the promised date. So now this is the same case. If the customer promised to pay us in here, but the customer end up paying us before the 15th, therefore it is irrelevant of us to be recording anything on the 15th because we received the promise before the promise date. So now let us leave that one, then we continue from our analysis. So now It says, according to the terms of the contract, GAAP Limited will obtain control of these products after each performance obligation has been completed. So now that means after every performance obligation is done, therefore now the company can recognize revenue. Why? Because the customer would have obtained the control of all these products after the obligation has been performed. That means after the company has supplied the decoder and the dish, the customer will obtain control. Therefore, the company, which is Digital Limited, can therefore recognize revenue. Where we credit revenue, then what to be debited will be decided, because there are many debits that can be there. Then now it further says, and once again, that means after the installation is done, therefore now the company can recognize revenue. Why? Because the customer would have obtained control after the installation is done. Therefore now when the customer obtains control after the company has performed, therefore the company, in the context of this one being Digital Limited, then can recognize revenue, credit revenue, then debit whatever account that will be necessary depending on the scenario. Now let us continue on that same note. It further says that the decoder and the dish were delivered. Now this is another date. Remember our date number 1, I normally put numbers on the dates in terms of which date are we going to start with when necessary. Our date number 1 is this one. Remember, this date is important if the customer pays after. But if the customer pays before, this date is not important. At the same time, if the customer pays on this date, then this date is important, because we will be recording cash that we have received on the date the customer promised to pay us. Now this date is important, more especially if we receive cash after, then it will be important for a non-cancelable contract. We'll see all of that when we do the answers. Now it further says that the company now delivered on the 25th of January. This is date number 2. Remember, this is 15, then after 25th, and we can see that from the 15 we have not yet received money from the customer, and we are being told that the decoder and the dish were delivered. That means now the company has done the supply of their first performance obligation, which is the supply of the products, which is the supply of the products. It is the decoder and the dish, and these ones are worth 2,500. Now the company has supplied the decoder and the dish. Remember, we're told that the customer, which is GAAP Limited, will obtain control of these products after each performance has been done. So now after the performance, which is the supply of the decoder and the dish, was done worth 2.5, then the customer has obtained control. But we are further told that the installation of this dish was done on the 1st of February. And we know that after this is done, the customer obtained control of the installation, and the installation is worth 1,500. So this is performance obligation number 2, and they are crisscross if you see them here, but still easy to analyze. Now this is date number 3. Date number 2 is this one. Now we are on date number 3. It further says the payment was received on the 20th of January. Let us look at the dates now. Look at the dates. Our date number 1 is right, 15. Date number 2 is the 20th of January. Now let us do the corrections on our dates. Sometimes dates can be up and down, and you need to put them in order because they are important for the order of recording. Then date number 3 will be the 25th of January, and date number 4 will be the 1st of February. So now we have these dates in this order. Let me make sure that I write them in that correct order. Date number 1, date number 2, we receive money. Date number 3, we performed our obligation 25th of January. Date number 4, we performed obligation number 2. So now these are the dates in the order. That means when we performed our obligation, it was after we have received money. Previously, I said we had not received money. I did not see that the date was given later on, which is the date before we performed our obligation. And this can be confusing, and it can make you sometimes record journal entries incorrectly. Hence, analyzing all the information first becomes very crucial. Then we are to prepare general entries, assuming that the contract is cancelable in the event of non-compliance. Now, let us look at the dates now when the contract is cancelable. Now, we have seen that the customer paid us after the promise date. The customer paid after the promise date. Customer paid after the promise date. And after the promise date, we can see that it is the 20th of January, not the 15th of January as the customer is promised. So now, because the contract is cancelable, then we cannot say that customer, you are owing us, because this contract can be cancelled if another party does not perform. That means in the event of non-compliance. Now, the fact that the customer has not paid in here, that means the company named Digital Limited, they can say, no customer, let's cancel this contract. You are not owing me, because this is cancelable in the event of non-compliance. So if you customer, you don't comply by making a payment as agreed, let's cancel the deal. Then we no longer have a contract. Therefore, now, this date is not important when the contract is a cancelable contract, because a contract can be cancelled. It is not binding that you are owing me one way or the other because of the contract. The contract can be cancelled in the event another party does not comply with the terms of agreement of the contract. So now that means we are not recording anything on that date. Therefore, now, that means we have to move to date number 2, because remember, we are dealing with the contract that is a cancelable contract. Date number 2 that we must also look at is the date we receive money. So now this date is important for recording in the case of a cancelable contract, because we received money on the 20th of January. So now we have to debit our bank account because we received money. We know that in any general journal or in any accounting transaction, when cash is received, we debit bank, and the bank will be an amount of 3,500. Now we need to ask ourselves, what will be credited? Now the answer will depend if have we performed our obligation yet or not. And obviously the answer is not. We have not yet performed our obligation. That means we still have the liability to perform our obligation for the money that we have received. That means we have not yet earned income for the money that we have received. So we cannot recognize revenue. So now we have to say we are still owing your customer a liability, meaning an obligation, contract liability. That means we are still owing you an obligation to perform, and this obligation is worth 3,500. So now we are owing your customer. We acknowledge that we received money, that is debit, but we still have performance obligation, which is the liability. We are liable to do something that is worth 3,500 of the cash that we have received. Please also look at the narrations. I normally don't go to the details of the narrations, but the narration is acknowledging the cash that is received from the customer, yet the obligation is not yet performed. Now we go to the second date. The second date worth of recording is now date number 3 according to the order of the dates. Date number 3 is the 25th of January 2018, where now we performed one of our obligation, which is the decoder and the dish that were delivered. And we know that the decoder and the dish that were delivered, we know that they are worth an amount of 2,500, the supply, and that is the supply of the decoder and the dish. That's where the word supply came from. So now we have supplied, meaning performed, our performance obligation number 1 worth 2,500. And we know that after every obligation has been performed, the company will obtain, or the customer will obtain, control. Therefore, now we can recognize revenue only when the customer has obtained control. Now we need to say revenue. We know that the credit entry is revenue whenever we perform an obligation and the customer is in control. Now, first question is, what do we debit? We have, remember, already received money for the revenue that we are recognizing. So now what are we going to do is to reduce the liability. Because when we perform our obligation, we get rid of the liability to perform our obligation. Remember, contract liability here was the obligation to perform our obligation. So now, or it was the mandate or an obligation to perform our duty as we promised to perform. So now when we perform our duty, therefore we are reducing our liability to perform our obligation, meaning we are no longer liable to perform an obligation that is worth 2.5 because we have already performed that. So now let us reduce our obligation, meaning our liability, by debiting contract liability. Remember, do not ever debit contract liability if previously there was no contract liability. Do not ever debit contract liability if previously there was no contract liability. There must have been a contract liability that was credited before. Remember, this is the payment of the previous liability. You can never decrease a liability that you did not have before. You must first have a liability before in order for you to decrease that liability. So now when we decrease this liability in here, there must have been a liability before, and there was a liability before. So please take note of that. It is also some of the important basics that you need to master so that you don't make some small errors in your journals. Therefore, now we have performed our obligation and the customer is in control. We credited revenue. Now, as we perform our obligation and we earned income, then now we have to reduce the liability of the obligation that we had before. So now that was the first supply or the first performance obligation, which was the supply of the decoder and the digital dish. Therefore, now we go to the next date. Remember, we are dealing with a cancelable contract in the event of non-compliance. Just to refresh on that. The next date is the 1st of February 2018. Now on the 1st of February 2018, we need to take into account the fact that we have performed another obligation. We have performed another obligation. Now, when we perform another obligation, therefore now we have to recognize our revenue. We have to recognize our revenue of 1,000 rands. Let us verify that also. It further says that, but the installation of the dish was done on the 1st of February 2018, and we know that according to the terms of the contract, GAAP Limited will obtain control of these products after each performance is completed. Now, we have done the installation, meaning completed the second obligation. Therefore, now because of that, that means we can now be able to say revenue. Therefore, now remember, question is, do we still have a previous liability? The answer is yes. Remember, our liability was 3,500 and we decreased our liability by 2.5. That means on the credit side of contract liability, in the previous recording, I opened a ledger account. Please picture the same ledger account from the previous recording, which was on question 9, if my memory still serves me very well. On the credit side now, our balance brought down. After we debited this in that ledger account, we still have 1,000 rands on the credit side. because we only reduced our liability by 2,500. So there was 1,000 rand, which is still a liability. And this liability is only going to be reduced when we perform our second obligation. So now we must then again now debit our contract liability. Contract liability is debited by an amount of 1,000 rand. Now the question is, do we still have a liability? No. Our liability is a debit of 1,000, a debit of 1,000. The total of 1,000 plus 1,000 is 3,500. And we had a liability after we received cash of 3,000. So total debit of liability equals total credit. That means we no longer have a liability after we have performed all of our obligation. You can't perform all the obligation and the customer has control and you still have the liability. Make sure that if there was liability after the end, then now all liabilities must be debited with the total amount of the liability that was on the credit side, if that was the initial case. So now we have dealt with this and all is done and dusted. And now this contract, remember, it is the contract that is a cancelable contract. And we received, I want to take note of this, we received cash, meaning we received money before we performed our obligation. And this is very important, and I am tempted to adjust this question. Here we received the money, we received cash before our performance obligation. So this is how we have recorded. Now I want us to say we receive money after our performance obligation. Still in the same contract, guys. Please bear with me. I did not intend to adjust this question, but I am tempted. I think this will cover comprehensively the other aspects of this question from other questions also. Now I am saying we received the money after the performance obligation have been done. In other words, let us change the date here and say the payment was received on the let us change the date. The payment was received on the 15th of February 2018. Now I want us to change this. The contract is still the same contract, is still a cancelable contract. How do we then deal with this if cash or money was received after we have performed performance obligation 1 and performance obligation 2? And this will bring the other aspect now of the contract asset and the contract and the receivable asset that I want to bring to your attention. Now that means this date now is still not important. Why? Because we are dealing with a cancelable contract in the event of non-performance. So now we are assuming that we received the money after the second performance obligation, 15th of February 2018, which is after the second performance obligation. Therefore, now the first date that will be important will be 25th of January 2018. So now let us record on the 25th of January 2018. What are we going to say? We are going to say debit contract asset now. It changes completely. Debit contract asset. Then we credit revenue. Remember, after we have performed our obligation worth 2,500, the customer obtained control. Those ones, they remain the same. The customer obtained control. Why are we debiting contract asset? If you go to page 130 of your book, the two bullet points there before that example, I'm not sure if it's example 1 or example 2, but before the example that is in there on page 130 on Gripping GAAP 2021-2022 version, it says there that when we do a revenue recognition entry, we credit revenue, but we debit bank if cash is received after you performed the obligation. And it further says, if cash is not received on the date you performed the obligation. Therefore, we must decide which entries to be debited. And it says one of them is contract asset under the bullet point there, the second last bullet point before the example. It says we say contract asset if the company obtains a conditional right, obtains a conditional right to the consideration. Yes, if the company obtains a conditional right to the consideration, and it explains further what is the conditional right to a consideration. It further says that a conditional right to a consideration is when the company still has another obligation to do. That means after we have performed this obligation, there is still another duty the company must do. It says it depends upon something happening, meaning performing another future obligation. Therefore, the question is, after we have performed the first obligation, which is the delivery of the decoder and the dish that are worth 2,500, do we still have something else to do? The answer is yes, we still have to install them. So if the answer is yes, you still have to install, and the contract is cancelable. Therefore, what do you debit? You debit contract asset. If you still have something else to do, take note. If you still have something else to do and the contract is cancelable, therefore now we debit a contract asset. Then now if we no longer have anything else to do, that means we have satisfied all of our obligation. That is the second bullet point that is just above the example on page 130. That means if we have satisfied all of our obligation, that means we have nothing else to do but waiting for the customer to make a payment. What do we debit? We debit receivable asset. We debit receivable asset, or account receivables is the same thing. So now these are the two asset accounts that are very important in the case where we perform an obligation before we receive money and the contract is cancelable. I want to make it very clear. Remember, I said when the contract is non-cancelable, you will never have contract asset. You will always have receivable. So now that is why we debit contract asset. The second date that will be important is the date of the second obligation, 1st of February, where now we do the installation, and the installation is worth 1,000 rand. Therefore, now we say we have done the installation. We credit revenue. We know that this is a revenue recognition transaction by an amount of 1,000 rand. What do we debit now? We cannot debit contract asset anymore. Why? Because we have satisfied all of our obligation. And that is a second bullet point just above, or the bullet point above the example on page 130. The bullet point above page 130 example. That bullet point says the company obtains an unconditional right when it has satisfied all of its obligation but waiting for the customer to pay. Therefore now, after we have satisfied all of our obligation and we are doing a revenue recognition general entry, we debit a receivable asset. We debit receivable asset. This will be an amount of 1,000 rand. Why? Because we have satisfied all of our obligation. There is no longer future obligation that must be done. After this date, remember that we have done all of our obligation. Therefore, we no longer want to have contract asset in our account anymore, because contract asset means we still have future obligation to do. But the receivable asset says we no longer have any future obligation to do. We have satisfied all of our obligation. Therefore, now the account called contract asset must be removed. Therefore, now we need to transfer everything under the receivable asset. Under the receivable asset account. Then we credit contract asset. Therefore, now we are getting rid of the account that says we still have something else to do. And we record under the account that says we have nothing else to do. We have satisfied all of our obligation. That is an unconditional right the company has obtained to a consideration, which is the receivable asset in this case. And I also want to bring this to our attention. Please note this is not in the examples that I dealt with so far. If it were to happen that in between here, the customer paid this 2.5, this transaction will be null and void. Be clear on that. I don't want to say, but Mineri, you said after that you must get rid of the contract asset, then after you transfer everything under receivable asset. Yes, that is correct. If you still have contract asset, that means if the customer did not pay you after this date, but before the date to perform the second obligation. So now if it does happen that the customer pays us somewhere here in the middle, before we perform our second obligation, the customer pays us. When the customer pays us, we are going to debit bank and we are going to credit contract asset by an amount of 2,500, an amount of 2,500. So when we get now in this transaction, that means we no longer have any contract asset anymore. Therefore, this transaction will become null and void. So please be mindful of the dynamics, guys. I don't want students to memorize. I want people who understand the topic very well. Because as examiners or teachers or lecturers, we can change one thing and it change the entire scenario. But if you master your work, then you'll be able to manage yourself. Now, after that, remember now we are saying the customer paid us after we performed our obligation and the contract is still a cancelable contract. So now we have dealt with that. Therefore, now when we receive money on this date, it is very simple and it is very easy. We are going to be debiting bank because we receive money and no longer revenue because we have already recorded our revenue. We will credit receivable asset and this will be an amount of 3,500, an amount of 3,500. I apologize to make this adjustment. Remember, this is where we received cash. We received cash after our performance obligation, meaning we first performed the obligation number 1 in a cancelable contract. Remember, did obligation 2, then we transfer everything to the receivable asset, then after we receive money later on. Please take note that dates are very important. Write your dates in there. I don't have time to be writing dates. My focus is just on dealing with the context and analyzing the information provided. Narrations are still very crucial. Please do write those narrations in there. When you are in industry, you will be required to write the narrations. A narration is just explaining the transaction. Now we are coming to the last journal entries, and these ones I'll just do them as they appear. Maybe I might do an amendment and adjust here and there. I will see as the spirit of teaching leads me. Now the contract is a non-cancelable contract, and in the event of non-performance, that means even if another party does not perform, this contract is binding. It's like marriage, life and death. And there are some vows that are said there. It says, for better or worse, or till death do us apart. Until we die, we are in this deal. Now, therefore now, because this is a very binding contract, either another one does not comply, we will die together. You are owing me on that date. So if the customer does not pay on this date, but the customer pays on the 20th, as we see here, that means we must record on this date that customer, you are owing us. And what you are owing us is an unconditional right to consideration. Remember, when I'm saying unconditional right to consideration, I am referring to page 130. That means there are no conditions I don't have to do something as a company, meaning I don't have to perform anything as a company, but you are owing me because this contract is a non-cancelable contract. So now we have to record on this date. It becomes an important date. Then after we receive money from the customer on the 20th, which is date number 2, date number 1, date number 3 is the 25th of January, and date number 4 is the 1st of February. So that will be the order of our recording for a contract that is a non-cancelable contract. Now let us go there and we do the recording. Now on the 15th of January, we are telling the customer that, customer, remember this is a non-cancelable contract. You are owing us on the date you promised to pay us. If you don't pay us on that date, remember those conditions. So now we are saying receivable asset. We are saying receivable asset of 3,500. We are saying, customer, you are owing us unconditionally. This contract is binding. Then after, we cannot recognize revenue because we have not yet performed our obligation. So now we have to say, customer, although you are owing us, we are still owing you the obligation to perform. Contract liability. Contract liability. We are owing you the obligation to perform. And our obligation that we'll be performing is equivalent to how much you are owing us, 3,500 on the 15th of January. Therefore, now the customer paid us on the 20th. Remember, on the 20th, the customer made the payment before we performed our obligation. Now the customer came and made the payment 20th of January, before the 25th of January, and it's before the 1st of February. So now that means we have to recognize bank or recognize cash. The customer paid the entire 3,500. Now in this case, obviously, the customer is circling the account that he was owing us, the receivable asset. So now that means the account of the customer must decrease by the amount the customer has paid us, which is 3,500 rands. So now this is how we will be reducing the account of the customer when the customer pays what he was owing us. Now that means the debit side is already written off because the customer paid. What is short is for us to perform our obligation, and as we perform our obligation, we will be decreasing that liability whenever we perform our obligation, because we have a liability before. Remember, before I said don't ever debit contract liability if contract liability was never credited before. So now we have performed our obligation on the 25th of January, and this is the delivery. The delivery, we know that it is the supply of 2.5 of the digital dish and the decoder. So now let us record that. We know that when we perform our obligation and the customer has control, therefore now we can be able to say 2,500 is our revenue. Therefore now we have to be decreasing our contract liability. Decrease our contract liability by 2,500 rands. Then after, we can draw the line. Remember, when we recognize revenue, we debit contract liability if there was a contract liability before. I think you can also say that one before. Previously, we were dealing with the revenue and it was against receivable asset. So now revenue is, when revenue is credited, there are alternative options of debit that can be done in there. It depends to what happened first. And I did not ask that question in this recording. Now of what happened first. Then after we performed the second obligation. Second obligation is performed. Then after we reduce our liability once again. If you had a liability before, then now what happened? When you perform an obligation, you reduce that liability by debiting the liability and you credit revenue on the date the customer has obtained control. And we were told that after every performance is completed, the customer obtained control. Now you can see now in this one, the major difference is the fact that this date is the 15th of January, the promise date. So this is the date we recorded. But when the contract was cancelable, we recorded the same amount, but the date was not that date. So now we did not record anything on the 15th, sorry. We did not record anything on the 15th, but we recorded as per our performance obligation. That means when we performed, if you remember, when we performed, in this case, when we performed this obligation, then we debited a contract asset. So now there was no obligation, and you only get to have an obligation if you receive money before time. That will be the contract liability. That is the only time you will have contract liability. If the customer is supposed to have paid you, or you receive money before time, then you'll have contract liability. And the time you'll have contract liability is also when the contract is non-cancelable, the date the customer promised to pay you. And that is the one we'll dealt with. With those words, what else can I amend in closure in here is the fact that the customer in this case paid us before we performed our obligation. If you say that we billed the customer here, this was billing the customer on the day the customer promised. After we billed the customer after a couple of days, which is 5 days, the customer made a payment and settled the bill. Then after we performed our obligation in order to settle our liability, our obligation in order to settle our liability, or to pay our liability, and then after settle our liability. So now what then would be the way if the payment is done before? If the payment is done before time, the only thing that will change is the fact that instead of the contra receivable asset, if the customer pay before this date, this will be bank. That will be bank. Therefore now this entry will not exist. Therefore now this entry will remain the same, and this entry will remain the same. If we receive money before time, we are going to debit bank 3.5, credit contract liability. Therefore now that means that will mean there was no receivable at all. Then after we have to settle our obligation by performing our obligation, or must settle our liability by performing our obligation. So now that is the only one small adjustment that I can bring to your mind, which is the other side of this transaction. But you can adjust the dates up and down and make them a bit challenging. But with those words, guys, thank you very much. I hope this added value to your knowledge. Be blessed, and I hope you get distinction and 100% in this question. Remain lovely. Thank you.